We are live from the JP Morgan India Investor Summit, and we are in conversation with Oganes, Head of Global Macro Research, on all things macro, and particularly emanating from the West and impacting the East, EMs and India. Luis, so good talking to you. Thank you for taking the time out.
Thank you for having me here.
The pleasure is entirely ours. Well, you spent about 4 or 5 hours in the conference already, I presume. What has been the top of mind for investors who are seeking your opinion? Is it the central banking action? Is it valuations? Is it the upcoming elections in the US? What stands out top of mind?
It is interesting that India has all of a sudden become a center of gravity within EM. And not only EM, I mean globally, when people look at, okay, what is the next frontier in terms of opportunities, medium, long-term opportunities, India is topping the charts these days. I was in New York 2 weeks ago. We had this global macro conference, and we did ask in a survey to investors, we're like 300 people in the room, what is the country within EM where you see the most promise and that can outperform over the next coming years? And India was topping the charts, and these are people that are investing both in fixed income and in equities, but also in the real economy. So I think a lot of promise, certainly.
Wow, so India stands out. Amazing. Okay, can I just probe that question a little bit before I get to the Fed action and the resultant impact thereof? So I'm told by your team here that this conference has 30% more participation than the previous year. It's probably the largest interest that the global investing community has shown. You were in New York, you are kind of corroborating that. Everybody when I talk to about India has one question, which is, oh, valuations are expensive. And then I hear the people who are investing saying that valuations in India have always been expensive. So therefore, we have to go in with that concern at the back of our mind, but there is no other choice there. So I'm just trying to understand when you think about India and when you look at the interest that is there, does valuation become an impediment, or is valuation something that you keep an eye out for, but not necessarily an impediment?
Well, I have two hats of an economist and a strategist, right? I mean, as an economist, I look at more medium-term trends, right? And you can say that, India, things are, generally speaking, going well. A lot of these macro imbalances that India used to have, a very large current account deficit, very large fiscal deficits, they have shrunk, and India, macroeconomically speaking, is in a better place. It is, largest population in the planet. It doesn't have the demographic challenges of other places, including China or developed market economies. And so, from that perspective, there's a lot of promise, and there's optimism. From the strategy side, obviously valuations do matter, right? Because you have to speak to investors that have an investment horizon over the next 3 months, or maybe, if you're more long-term, is 1 year, right? And within that, you need to be mindful how much markets have rallied already, and then you reduce your chips and put them somewhere else. So that is always a stop-and-go process. So, certainly Indian assets have done well. Can they continue to do well? Yes, I think they can. But, I'm not going to go against someone that says, hey, Indian equities are expensive, they have rallied a lot, maybe it's time to take profits. The question then is, okay, if you sell here, where do you go? The opportunities are not that plentiful, to be very honest. And especially, and we're going to be discussing this in a minute, I'm sure, ahead of US elections that can alter the playing field. It is a difficult moment to make big investment decisions, right? So I would say that it is the macroeconomics are going in the right direction, and I think that for those investors that choose to stay long in India, I don't think they'll do badly.
Okay, it's an interesting time to have an India Investor Conference wedged as it is between the start of, presumably the start of an easing cycle, but just before, a couple of months before the big election. So how do you juxtapose both of these when you're trying to take a call on EMs and India? Let's maybe start with the Fed, maybe.
Well, the Fed certainly. I mean, we have had so many false starts related to expectations of Fed easing, right? Remember that we closed last year, started 2024, expecting the market pricing 7 25 basis point cuts that would start as early as March. Well, guess what? That didn't happen, right? And it only started literally last week, mid-September. Started in a bold way, 50 basis points, in line with what our US economists expected, although that was not a consensus view. Some people were thinking that it could just start with 25. If you look at the combination of Fed easing, right, and a U.S. economy that is weakening for sure, that is what is allowing the Fed to ease, but it's moving more towards what we would describe as a soft landing. There is some odd probability of recession, which is not to fully discount, but the probability of recession is maybe 25–30%. I don't know. The data, though, doesn't seem to suggest that recession is around the corner, right? That's why we are more comfortable. Our base case scenario is soft landing, not recession. You have a situation where the Fed cutting is going to allow EM central banks to cut. Some of them already started. Some of them started and then slowed down because the Fed wasn't moving. Now that the Fed starts moving, that's the green light for central banks across the world, including India, to pursue easing. U.S. not going into a recession means that there is support for global growth. China deceleration is an issue for EM. The good news about China is that it is decelerating, but its commodities demand, which for many countries is an important link to China, remains rather strong. So they're not feeling the pinch from Chinese economic deceleration. So you look at all these factors and you're like, okay, what's not to like? And we are expecting that, all else equal, we may see more capital flows coming into emerging market economies. All this said, the problem is the U.S. elections, right? And there are some pronouncements, some proposals that are being espoused that could alter these dynamics, particularly, the broad use of tariffs that one of the two candidates, former President Trump, is proposing in a very clear way at this stage. So, we have to believe that he'll try to move in that direction. That could have some important implications for EM. And that is why I think that right this minute, even though the environment is turning more supportive for emerging markets, and India is included in there, I think that investors probably are holding their breath, right? And say, well, we have this very important event a couple months from now. Let's not rush to conclusions here.
Also, coupled with that, I'm just thinking out loud that if you look at the EM basket, the four large ones, three of them, China, not feeling the pinch but slowing, Korea, Taiwan, kind of slowing, India probably standing out. So therefore, the case for making a full-scale beeline for EMs, because of this and ahead of the elections, therefore, might be not that strong. So would you believe that while in the past, a rate easing cycle has led to presumably a sizable flow of money into emerging markets, this time around, in the immediate future, the next 2 months or 3 months, that flow might not be as strong?
It may not be as strong, generally speaking, just because we have this discrete, we're late in the year, right? Allocations for the year have already been made. So I think that the promise of stronger capital inflows for EM is more at 2025 rather than late 2024 event, right? Promise. But again, a lot will depend. What can upset this picture is a U.S. election outcome and what whoever gets elected does, right? So U.S. elections, whether we like it or not, do matter for markets, do matter for the U.S. economy, and has repercussions for EM. So I think that, let's hope for the best, right? That some of the more extreme policy proposals that are being mentioned so freely in this campaign don't come to fruition, do not materialize, and that all the other elements that are supportive for capital flows coming back into EM, do end up materializing and do end up generating the influence that we all expect.
That's right. Yep, cross fingers for that. The other aspect of that is also the fixed income market in India. And the JP Morgan Bond Inclusion Index, some other indices following suit. The expectation was of whatever 30-odd billion in the current fiscal, and then as the years go by, some more. What is your view, not on Indian equities, but on the other aspect, which is the Indian fixed income? Any thoughts there?
Well, something very interesting is happening. So, the announcement of India index inclusion, happened already a year ago, I think, certainly way ahead of the start of the inclusion, yes, which happened in June this year, right? Before the index, the formal process started, we calculated that, from going from zero, so basically India not including the index, to the 10% that India will eventually have in the index, if people just wanted to replicate the index, given how much of assets under management use this index as the benchmark, the GBIM, we calculated between 25 and $30 billion, as you said, of purchases of Indian government bonds, right? Before the process started already, there was $10 billion of foreign investment into the Indian bond market. So people started to anticipate inclusion and they started to buy. So there was, strictly speaking, 15, 20 billion left, let's say, of inflows. If you divide that by, the 10 months, we're talking about 1.5 to $2 billion per month. What we have seen June, July, August, we still don't have a full number for September. We have seen around $2.5 billion of inflows into the Indian bond market per month, right? So more than what the pace that we were expecting. And you will wonder, so which is good news, right? But you wonder why, and I think that there's, I'm sure, a lot of technical reasons. The bonds had a wider spread compared to swaps, so there was an asset selection that favored bonds. But I think that I want to say, that's probably one demonstration of the interest and the appeal of India. And I have to say that within the Asian context, India has now is increasingly becoming an interesting liquid, quote-unquote, high yielder, right? The other high yielder is Indonesia in this region, right? Yields are higher than, certainly, Korea, Thailand, and other countries, or China for that matter. But, there are some question marks on the fiscal side, on the political side in Indonesia that are probably keeping investors a little bit more cautious. And India, well, we already mentioned, right? I mean, the macro disequilibrium, disequilibria that was dominant years past have been addressed or reduced. So there's more comfort with India. So I think that's a good demonstration. So beyond the equity picture that we described before, in the fixed income side, there is also, so far, the optimism is materializing in more inflows, interestingly.
Yeah. Nice. Just does the favorable macro indicators, I mean, the current account deficit looking very okay, forex reserves high, and for a net commodity importing country, the fact that commodities have come off, including oil, does that augur very well for this story to stay attractive going into the next 6 to 9 odd months, even as we are looking at the US elections coming around November?
Yes, and particularly in the case of oil, right? So oil prices, our team has a projection that oil prices are going to point lower next year. So far, the market has been relatively balanced, meaning supply and demand matching each other. That has been accomplished. There's been more supply coming from non-OPEC producers, the likes of the US itself, Brazil, Suriname, Senegal, Guyana, you name it. And the ones that have been keeping the market balanced has been Saudi Arabia and actually Russia, for that matter. So OPEC plus, doing the cuts. For next year, there is a question mark as to how much OPEC is going to be willing to keep cutting production to offset the higher production from non-OPEC. And some of the rhetoric, and there's an OPEC meeting before the end of the year, so we'll find out soon enough, I guess. Some of the rhetoric is that they are running out of patience of losing market share, and they may not be willing to do it, and maybe they shake the market up by, hey, we're going to increase production, allow oil prices to go lower. We don't know. But even without that, given the projections of supply and where we're seeing demand, our team expects oil to maybe finish next year in the mid-60s, per barrel, right? We have been hovering between 70 and 80, as you know, for a long period of time now. So we're entering a lower oil price period, which is obviously supportive for India, right? So, and interestingly enough, both Trump and Harris as candidates, a lot of their pronouncements also, they want to push for lower prices. Different strategies, but lower prices as well. That is not in our projections. So 65 is just supply and demand. Does not incorporate a U.S. elections outcome, does not incorporate U.S. recession that could happen, or doesn't incorporate an increase in production by OPEC, right? So I think that all the risks point south for oil, which is good news for India.
Which is good news. So my final question really, Luis, what about the risks to this quote-unquote, not quote-unquote, but kind of a Goldilocks scenario, if you will, geopolitically favorably placed, growth-wise reasonably favorably placed, looking at what's happening around the world. Macro is looking pretty okay too. What are the risks to this?
The risks honestly come at this stage more from geopolitical or political outcomes, right? Geopolitically, we have seen the situation in the Middle East very complicated. So far, it's been the right trade, quote unquote, to fade the geopolitical risk, meaning that all the nasty headlines that we have seen coming out of, Israel, Gaza, and expansion and all these proxies of Iran, etc., no single barrel of oil has been affected because of all these dynamics, right? So when oil prices at the beginning of the conflict, when there was the attack on Israel last year, oil prices went higher. That didn't last for too long, and for a good reason, which is there's no tightness generated in the market whatsoever. But every day we wake up to some new news, right? And we cannot completely rule out that there's some kind of event or miscalculation, whatever, that ends up eventually affecting oil markets. And that could be the one area of risk that I think there's no risk premium in the market right now in prices that could surprise us, right? So something to watch. And the other one, well, I keep going back to the U.S. elections. If former President Trump gets elected, he is trying to push for these tariff increases. So he's trying to bring back production manufacturing to the U.S., right? He doesn't believe in friendshoring or nearshoring. He wants reshoring, right? Come back to the U.S. Let's leave import tariffs so that to make imports more expensive, and let's create incentives for people to bring manufacturing back to the U.S. The problem with that is, there will be higher inflation in the U.S. Possibly. So it is a fallacy that the tariff is going to be paid by the exporter countries. No, the tariff is going to be paid by the U.S. consumer, right? Yeah. So that is one aspect of it. But for the rest of the world and emerging markets, which is what we're talking about here, the way in which countries are going to respond, and particularly China, he wants to slap 60% tariffs, right? The currency will do part of the adjustment. The moment that CNY, the renminbi, the Chinese yuan depreciates, right, that is going to make Chinese exports more competitive, right, or compensate part of the tariff for exporting to the U.S. But for the rest of the world, particularly Asia, and I think that India will probably get its share of impact, it would generate a flooding of cheap exports from China to the region, right? So that would compete with India manufacturing, Korean, Taiwan, Japanese manufacturing. So there will be pressure on all these countries either to impose their own tariffs on China and or depreciate their currencies in order to not lose competitiveness vis-a-vis Chinese exports, right? So it feels like a race to the bottom, right? We hope that we don't get there. But that is, you're asking me for risks. Well, I'm describing something to watch.
Thank you. Much appreciated this, but fantastic talking to you, Luis. Thanks for laying it out so well, the global construct and how it could impact India, because it's great from an Indian investor's perspective to keep an eye out on some of these. So really appreciate your time.
Pleasure to be here. Thank you.
Not at all. And viewers, thanks for tuning into this fantastic conversation with Luis Oganes, who looks at the global macro research at JP Morgan, right out of the JP Morgan India Investor Summit.